it would be great, Mark, if you could give a bit of an intro on yourself, and yeah, how you found yourself at Compound as well.
Yeah, so sounds good. So my name is Mark Cecchini, and I'm a financial advisor. I've been doing this for about 10 years with private clients across private wealth management, fintech companies. I'm a certified financial planner, which kind of requires education and exams and that sort of thing. I'm also a certified college financial counselor, which deals with student loan payoff, college funding, how to save for college. And then I'm on the third level of the CFA, which is Chartered Financial Analyst. I teach taxes and ethics through UCLA's financial planning program, and I work at Compound, basically serving tech employees and founders on all elements of wealth management.
Brilliant.
Um, yeah, my career has been a journey. I've been at very traditional wealth management firms, multi-billion-dollar fee-only RIAs. I've been a fiduciary my whole career, which means, basically I've never accepted commissions. I've never had to sell products like life insurance or anything like that. But I've served, kind of in three main capacities, one of which is financial planning. The other one is portfolio management. The other one is income tax. And so those are the three areas I've kind of built my career on, the whole time just serving clients in a very dedicated advisory capacity, meeting live, emails, phone calls, achieving goals, checking off those goals and those action items.
Nice. And so are you currently spanning all those three kind of pillars right now also? Are you kind of are you working with Compound primarily, or you still do it all?
Yeah, still do it all. So Compound is kind of a full service family office. So we do financial planning, tax management, tax preparations. We actually have in-house CPAs that prep tax returns, do tax projections, quarterly estimated payments, and then we manage investments directly for clients, both liquid and illiquid alternative investments that we do due diligence on, and we help clients kind of manage their company equity, both executing options and exercising equity grants, and then kind of how to manage a liquidity event pre and post, whether it's an IPO or tender offer or anything like that.
Okay, cool. So you also actually deal with it from the employer side. I thought it was primarily the employee, but you do it from both angles essentially.
Mostly employee. So we're sort of dealing with the end client, not necessarily dealing with like Stripe, for example. We went through their tender offer. We were just dealing with Stripe employees and past
Employees, I see.
employees and founders. Yep.
You're not necessarily setting up the company equity structure and like how much like equity they'll be allocating their employees and stuff like that. It's more the individual at Stripe who's being given equity, and then making sure that they're kind of aware of their offer or whatever it might be. Okay.
Correct.
Yeah.
That's the lion's share. We do a couple, like some of our clients are founders. And so they have questions about how much equity they should be offering, when they should offer, if they're starting a brand new seed stage startup with one of their friends, like how much to split that and when to incorporate. So we do a little bit of that side of it, but not much from a corporate sort of company side.
Okay, great. That's brilliant. Thank you so much for the background. And I've got about 8 questions in total when it comes
Okay.
to kind of equity offers. They're
Sure.
very broad and they're very expansive. So I appreciate that they're not necessarily things that can be probably distilled down into minute kind of detail. But it would be
Sure.
really great just to get a kind of broad sense from you on your kind of learnings. And I guess I'll start off with a bit of a personal story actually, because so after I left university, I actually had a job offer at a startup. I won't name the startup because I feel like it's unfair, but it did go on
Sure.
to become very, very successful. um,
Sure.
and I actually turned it down on the basis that I fundamentally didn't understand the equity offer I was being given at the time. And
Sure.
I guess I would kind of add something to that also, which was I really didn't understand the kind of the potential financial upside that I could have that I could have benefited from. And so that was probably about 10 years ago now. And what that did was it really was the catalyst for me to move into kind of fintech roles and insurance and into the finance space. And then through that, that's how I kind of started to think about concepts of finance, because I constantly from that moment encountered colleagues, friends, family who were all in positions where they were being offered either equity within an existing role, or they were moving to a role where they were potentially given equity. And so that kind of mistake of mine really piqued my interest in this space, and therefore led me to this. So this is a topic that's close
Sure.
to my heart, on the
Sure.
basis that I made a very big screw up very
Yep.
early days in my
Yeah.
career. So yeah, really interested to get your thoughts. Um,
Yeah. Yeah. Go ahead, please.
so great. So question one really is, you know, let's say tomorrow I get an offer from let's call me a product manager,
Sure.
kind of day-to-day role. I get an offer at organization and it comes with equity. What are, if you were to really condense it into two, three kind of key points of things that an individual absolutely has to do when it comes to due diligence with that offer, and that are absolutely non-negotiable from your perspective and from your experience, what would they be?
Sure. It's a great question. It is nuanced, but I think the three biggest things or four biggest things I would say is, where is the company right now, right? Take a snapshot of where the company is today. What stage are they at? Who are the investor group? What are they hiring for, right? Are they hiring a bunch of PMs at the same time or a bunch of engineers at the same time? And how do they come to the agreement to give your equity? And that's in that sort of both in terms of size and in terms of type, right? So that's the second thing, is what type of equity am I getting? Am I getting
Mhm.
NSOs, which we can dig into, NSOs versus ISOs, which are basically stock options. One's incentive stock options, the other one is non-qualified stock options. Is the company at a stage where they're granting RSUs or restricted stock units? Or am I just getting common stock in the company, which is typically reserved more for public companies, right? As opposed to just a private pre-IPO, pre-liquidity company. So that's the second thing, is type. The third thing is, what are my upside and downside scenarios, right? What is this going to potentially cost me in terms of exercise costs, right? Because sometimes you have to buy these options until they become yours. What's my vesting schedule? There are a lot of things we can go into, but I think having that sort of sense, or what my up and downside scenario is. And a key component of that is what percent of the company they're offering you, because they might say 50,000 options, which is fantastic, but there could be 25 million outstanding shares, right? So you're looking at a very, very small percent of the company. And so the questions to ask, are several, and we can get into a lot of them, but it's really sort of, what stage is the company in? What type of equity am I getting? How much of the company do I actually own, or will I actually own it as I vest over this period? And then the fourth thing would be, where is this company going, right? Is there a path to going public? Is there a path to a merger or acquisition? Is there a path to me rising in the company and getting refresher grants for outperformance and that sort of thing? But if this company were to be acquired for, say, $1 billion, right? That's the favorite unicorn size, right? That everyone talks
Yeah.
about. What would my actual financial payout be? And how long would I have to be there? And what are the other stipulations? So those are kind of the big broad strokes, I would say.
Okay, great. And can we just delve into some of those in a bit more detail also? So if we take the first one, what stage is the company currently at? Uh, I'm just going to give a kind of real life example of a conversation I had with someone relatively recently, where they were part of an organization that was very early days. So like below basically 15 people working at the organization, and they were
Sure.
given an equity percentage of that organization, which I actually felt was relatively low. Bearing in mind they
Sure.
were going to be the first person in their function, they were going to be building out that function, and I don't, maybe I'm not gonna, I won't disclose the amount, but I felt it was low. When someone perhaps has uh, that sense that it is low, what would be your advice in that scenario?
It's a great question. I think one of the things would want to understand is, what's the cash component, and is there wiggle room for the cash component versus the equity component, right? I think, first of all, there's negotiation openings for everything in a job offer, and I think there's coaches out there now, there are mentors and folks who are experts in negotiation that would say, 9 times out of 10, you should negotiate respectfully, right? All the worst they can typically do is say no. Of course, they could always rescind the offer. That's very, very atypical for someone to actually take back an offer if you came to the negotiating table with respect. But I think the percent matches typically your experience. And if it doesn't, then it should, right? It should say, what is a PM in my experience in, whether it's the big FANG companies or a very early stage seed company in San Francisco, wherever you live, is this comparable, right? There's a lot of forums out there you can see, is this comparable? And they do compare it by percentage, right? So you might think 0.5% for the first, one of 10 employees or something like that. You might think that's very small, but actually could be very big for, an individual contributor or a non-engineer or non-CTO. So there are a lot of comparables from that standpoint. But the other thing to think about is just kind of where you are in your own life, right? How are your finances set up? Because a lot of companies will give you choices now. When I joined my first startup, they gave me 3 choices when I got my offer letter. One was, a higher cash component, a
Mhm.
lower equity component, and then you tiered down to a lower cash component and a very high equity component. So in my moment in my life, I had to decide whether cash was more important to me that I could use for my goals and my savings and my investments, or was it higher cash with a future higher payout, but a very uncertain future.
Okay, great. And I have seen, or I should say, I have heard of that becoming a bit more commonplace. I mean, I haven't encountered that kind of flexibility myself over the last number of years, but I think it's really great that that's starting to be something that is coming through a little bit more.
Sure.
Um, that's really, really helpful. Thank you so much. And then
Sure.
the second one, and I think the other two, I think I touch on in further questions, but the second one is if you could expand even briefly on the various stock types that you might get offered as an employee. And I don't know if you're going to be able to go into all the pros and cons of each, probably not. But if you could just even just give a little kind of synopsis of each one, that'd be really wonderful.
Absolutely. So it depends on the stage of the company. And if you're an early, very early employee, even a founder, maybe you might maybe granted RSAs. And so those have very different sort of treatment. And they might be as low as 1 penny or a fraction of a penny in terms of their per share price. And so to vest your shares or to buy your shares, you might hand your founder $1, right? It's kind of a joke in startup
Yeah.
world. I hand my founder $1, I'm vested, I send my letter into the IRS, and now I'm fully kind of set up. So that's the easiest is sort of founder shares. Of course, there's investor preferred shares. There's a number of class shares as you're investing in startups, but we'll just focus on kind of employee stock. And so the next one would be an NSO, which is a non-qualified stock option. Basically, the value of your shares is your strike price, which you're kind of granted when you come on board, and then up to the company's current value, which is typically established by the 409A. And so if the 409A of the company is the same as your strike, there's kind of a net zero at the time, which is not a bad thing. If you get the offer and then the company waits a little bit to their board meeting and then the board approves your shares, your strike might actually be different than the one that your offer letter says. So that's kind of another negotiating chip if you're trying to figure out where am I going to be, is having the company say, we will lock in your strike price and will not change it until you're actually granted these shares. Because if the company's rapidly accelerating, you could have a new 409A, which is basically a private valuation of the company, and that changes your taxation. So when you exercise that NSO, you're going to be taxed on the difference between the 409A price and your strike price, and that's going to be treated as ordinary income, the same as your salary or bonus would be treated. That's in its most simplest terms. An ISO, on the other hand, is an incentive stock option. That is basically, it's very common in startup world, particularly if a company has gotten to the point where they're just issuing every new employee gets maybe 1,000 shares or 5,000 options, right? They're ISOs. The difference between ISO and NSO is the difference between 409A and strike is treated as an AMT under the US tax system, AMT or alternative minimum tax. And so when you exercise, you actually don't have a tax implication, but you may have an AMT implication if the delta between those two numbers is different or is large enough. That's called a bargain element. So ISOs are very preferential because if you do them right or do the strategy right, it can be long-term capital gains treatment on the entire difference between even looking out 10 years, the company IPOs, that minus your strike price is all long-term capital gains as opposed to ordinary income. So we like that, right? As people and as investors, we like long-term capital gains versus short-term. And then the last one is most commonly seen as RSUs, typically reserved for later stage companies like Instacart is a good example. They issue RSUs to all employees and have since, years from now or years in the past. And so basically those are restricted stock units. They're very similar to what you would get at a Meta or at a Netflix or anything like that. And basically you're subject to a vesting schedule. Typically it's a 4-year vesting schedule with a 1-year cliff, which means 1 year you get 25%. And then you vest monthly thereafter according to a certain schedule. And when you vest, typically you get hit with ordinary income, whether you like it or not, you don't have a choice. And so you basically vest and you can either sell them afterwards if the company is liquid, or you'd have to wait until the liquidity event to sell. That brings up double trigger, which means typically these companies do double trigger clauses because it's not fair to me necessarily to make me pay taxes on something I can't liquidate, even though options can be that way. So typically double trigger means they're not taxable until you vest and you have a liquidity event for the company. Like Stripe was that way just a couple months ago. All of their RSUs came triggered on the same day because they were opening up a tender offer for their company.
Okay. Fantastic. Brilliant. Thank you. That's really helpful overview. The uh, I guess in a similar vein, if it was 2, 3, the biggest mistakes that you see individuals making at the offer stage, either from almost either from like a very practical sense, or even indeed from like an emotional sense when they're wrapped up in that kind of job offer excitement, excitement kind of moment.
Sure. I think number one would be not negotiating, right? Just being so excited and kind of
Yeah.
letting your excitement about the position. And I've been there, right? It's very exciting. I was coming from a very traditional wealth management role to kind of startup. You think about all the potential, you think about what this equity could mean for you because you hear the stories of people being early to a company, the company explodes, it's a life-changing, multi-generational wealth creating event. So accepting without asking questions or without negotiating, I think is number one.
Mhm.
The second one is not asking for a higher equity stake. I think typically when companies make that initial offer, that is probably the lowest that they were going to go, right? So they're kind of trying to protect their cap table, which is just a schedule of ownership in the company. And they have a duty to their investors to return their investors the highest return on capital. And so they're probably not giving you the best first offer, right? In most
Mhm.
cases. So negotiating higher on the equity, potentially taking lower cash if you're in a position in life where you can accept a lower salary and bonus. And then I think not exercising shares is the second biggest mistake because a couple of reasons. One, as soon as you exercise, you're kind of locking in for NSOs that ordinary income impact, right? So you want that 409A to be as low as possible when you exercise. Of course, you need to weigh the pros and cons because that money could go to zero, and when you exercise, you actually
Yeah.
give up dollars. And the other thing is for QSBS, which is a very nuanced section of the tax code. It's called qualified small business stock. You can actually, if you held it for 5 years and have a couple other criteria that are met, you can exclude up to $10 million of capital gains,
Oh,
which is
wow.
an
Okay.
incredibly powerful tool. It's a little bit of a dated, sort of section of the tax code, but if you start the clock on that 5 years as soon as possible, you could potentially have a huge tax savings event. It could be the difference of millions of dollars. So not exercising soon enough. And even if you wait until the IPO, which a lot of people do, they might just say, hey, I don't want to risk it. I need this money. And as the 409A goes up, they're risking a lot more tax implication
Of
as
course.
they
Yeah.
vest. Um, they're just missing out on savings by starting that capital gains clock very early.
Okay, yeah, that makes complete sense. And I absolutely, I really love your first recommendation because it's in terms of just making sure that you negotiate. Because
Sure.
I feel like maybe in particular with very early stage companies, because potential employees are having a dialogue often directly with the founders, that there's almost this sense of I'm being a bit unreasonable for asking for more. And I think it really almost goes back to just trying to get a sense of your own worth, having a real dig around about what you're going to contribute to the growth of that company, and then making sure that you can somehow try to do that. What do they refer to it as? Almost that pre-mortem, where
Yeah.
is it pre-mortem they call it, where you
Yep.
basically say, okay, let's shove myself 4 years in the future, and I get X amount from this, and I've contributed all these things. Am I going to be, am I go, how am I going to feel? And obviously that's a very difficult exercise to undertake, but I think it's a really useful one to have. And
Right.
I think so many people still don't negotiate. So I really love that one.
I
Um,
agree. And I'll just add on real quick if I can is digging into the company I think is so important, right? Because you can get a lot of information around your equity by digging into the company, asking questions respectfully, right? Who are the investor group? Are you planning on bringing on more investor? When is the next round of funding do you anticipate? What is our cash runway, right? That's a little bit more sensitive. So you have to tiptoe around that one because that's really the true strength of the company. What is our plan for liquidity? Do we want to go all the way to IPO, which very few companies do, or do we want to be acquired? And will my dilution, that's the biggest one thing I haven't mentioned yet is dilution, right? So
yeah,
each round of funding, they typically take on more money and potentially more investors, and they bring on more employees. So each time that pot gets spread across more and more people. And so if I came onto the company and I had 1%, by the time we get to liquidity event, I might have 0.1%, right? 0.2% at most. And so that could still be an extraordinary amount of money, but you just don't know. And I've had people lock in dilution negotiation where they say, hey, can you maybe not dilute me until the series A, right? If we do that, I'm in, right? And that can save you millions of dollars.
yeah. I was going to touch on that one. So thank you so much
Yeah.
about the dilution piece. So are there any practical tips that you would give for that, for just trying to work out dilution? Like, I know there's a couple of there's a couple of tools and calculators online that are really, really helpful just
Yep.
to give a sense. But maybe I want to actually join it up with another question that I have, but I feel like it will be aligned with dilution, which is the valuation piece. So again, I'm just gonna make up this fictitious person who's joining a startup tomorrow with, let's say, 20 people. So it's very early days.
Sure.
And the how d like, how can you the question around valuation and how much a founder potentially might be willing to exit for at some point in the future. What would you advise people? How would you advise people to go about that conversation with the, let's call it the founder in this case? I know it could vary depending on the stage of the company, but for argument's sake, let's call it you're having a potential employees having that conversation with the founder.
Yeah, it's a great question, and it can be very difficult because I think you're starting to get into the role of the investor, right? Which is digging into, and a lot of times, companies will share their decks or they'll be available online, right? Their funding round decks will be online, and you can start to see, okay, what is the total addressable market, right? The TAM. What is kind of the moat, right? What is your competitive advantage? What things are you trying to kind of establish as product market fit, right? That classic product market fit. And when you think about the industry, you can start to see companies that have obviously exemplified the true unicorn or the multi-unicorn, because a lot of, for example, wealth tech companies, we're probably not going to be the $5 billion valuated company, right? When I think there's certain companies that were acquired for $1 billion, like Personal Capital was bought by Empower Retirement. That's a $1 billion company. But that's a good example where if I was evaluating a job with another similar company, I'm not going to say, well, let's look at my equity for a $10 billion acquisition, right?
Yeah.
We can all dream, but
Yeah.
that's probably not realistic for my particular industry. Now, if it's another sort of AI company, right, that the possibilities are endless. There's other companies like Stripe who are just, had a $50 billion valuation for their Series I round. And so it's difficult to know when you're at that stage. But when you're at a 20-person company, it's all about what is the founder's vision? What is the total addressable market? What is sort of the end game? Because some founders will tell you, hey, I think this is an acquisition sort of play. This is
Yes.
not an IPO sort of play. And you can maybe back into that figure. But just starting to act like an investor and starting to not grill the founder, but just ask them, inquisitively of what their plan is.
Okay, great. Thank you. I think that's yeah, that's super helpful. Uh, somewhat, these are also deeply interrelated, I know. But when it comes to timelines, from your experience, I mean, this is going to be so nuanced, and it's going to depend on the sector, on the founder's kind of vision, and all the things you just said. But when it comes to timelines, what do you think is reasonable for people to think about when it comes to equity, potentially releasing that equity at some point in the future, and how they should think about that time lapse?
Yeah, absolutely. And I think it's one of the most critical things to evaluating startup offer is being a little bit sober in the process, right? Because again, we can let ourselves get very, very dreamy about what the potential is, but the reality is that most Series B companies, I think 16% of Series B companies that make it past the A, which is a very big accomplishment, about 16% of them succeed, right? So it's a very small
Wow.
number.
16% of Series B companies
Companies
succeed to
will make it
IPO or acquisition or
will make it to any sort of liquidity event.
oh wow, okay. That's really
So I forget where that statistic comes from, but I think being sober in the process is very
okay.
important, because there may not be a liquidity event, even if you get to one, for maybe 10 years, right? Again, I think I use Stripe as an example because they're a multi-unicorn, but a lot of their employees waited 11 or 12 years to get that sort of taste of full liquidity, right? There might have been an internal tender offer where they let you sell 10% of your equity, or they might have set a price and their investor group came in and bought shares. But true liquidity, when you can go out and either have an IPO, may take 7 to 10 or more years. I think most companies now, it takes at least that time to get to liquidity event, because it's just super, super competitive, right? There are certain companies where if you join that true unicorn that, maybe goes public in 5 to 7 years, that's astounding. That is very, very astounding. So I think my main guidance to someone would be very sober in your assessment of the timeline, but still exercise your shares as you go. Take in mind your own financial situation and the cost. But there may be chances before the true liquidity event to get out. And I think I would tell a public employee of a public company, as you vest your RSUs, please sell them, right? Because it's just
yes.
too much concentration, it's too much risk. we don't know if the stock's going to go up. It's just too much speculation. So
Brilliant. That's really, yeah. And those timelines are actually, even just hearing them, is kind of quite sobering, even just
it is.
from just receiving it. And I'm not
Even
starting.
even most vesting schedules are 4 years, right? So
Yeah.
that's the minimum to get full vest of your original grant. And each
Yeah.
time you get a refresher, that 4-year clock typically starts over. So you can certainly still get a 1 year 25% vest and then go from there, and you're very happy. But that's the typical thing. And you can early exercise too. We didn't talk about that yet, but if the company allows, and that's something you should ask in the early stages, can I early exercise my options? Sometimes they will allow that.
Okay. Yeah. Great. Thank you. Then, like, what would you say are some, like, like red flags from a potential employee's perspective? Or I'm going to put it a bit more bluntly, like, if you were given an equity offer today, what would be some of the reasons that you might walk away from it, in terms of, like, information that potentially is not being shared, or it's, there's a couple of things that are making you feel a bit uneasy. What would they potentially be?
Sure. I think for one, it would be the m- unwillingness to share information. Every company is going to be very close to the vest on a couple of metrics, one of which is their actual revenue, right? Their actual true revenue number. Particularly at an early stage, it's just a very sensitive thing for people to know, and they could be shared and investors could turn things down. It's a very sensitive thing. So there, you have to be understanding on certain elements of privacy for the founders, and we should all be respectful of that. But if they're unwilling to share sort of their investor group, or how much capital they've raised to date, or sort of what their hiring plans are for your role, or kind of what your, obviously those are just normal job considerations, are what will I be responsible for, and what is my growth potential at this company. If they're unwilling to share kind of sort of the equity waterfall, right? The preference of who gets liquidated first. Say for example, they were liquid in 5 years. Obviously, they were the investors get paid out first, right? The preferred investors get paid out first. Then typically the other investors who have lower class share, and then the founders, and then the employees, right? There's typically this equity waterfall that happens. They should be willing to share high level details of that. They may not push across the table, the cap table exactly, but they should be willing to share that. And I think otherwise, just being sort of shady around the product, or not giving you insight into how they've raised capital or how they will raise capital. Because sometimes if it's a seed stage, they may only have $250,000 to work with. They really need to go raise a seed round or a Series A round to really get any sort of capital pot to work with. So those are things that would be red flag for me. And I think if they were completely unwilling to negotiate at all, that also might be a red flag, because typically companies know that people will counter. And so if they won't
Yes.
come to the table at all, that is to me a little bit of a red flag in this labor market.
Okay, yeah, that's really helpful. And just, I'll provide another personal kind of anecdote here. So I worked for an organization, I won't name it, but I worked for an organization where it was private equity backed, and the structure of the private equity capital that was flowing in was, in hindsight, was really not very well. Well, it's somewhat common. You'll be aware of it, but it was coming in basically tranches. And
Mm.
so the tranches then were linked to very specific targets, but those tranches were on a quarterly basis, which meant the company, broadly speaking, couldn't have a long-term vision, because it was so narrowly focused on what is going to happen in the next 3 months. And that really set the company up for a bit of a demise, and which ultimately happened. And I think in hindsight, I realized that understanding and probing more about that runway, in which case I would have, learned about the tranches in that case. And then immediately I would have said, oh, well, that actually structure doesn't sound very good, would have highlighted that to me. So, yeah, I think that what you say there around, just sensitively, again, trying to get under the skin of those topics is really important. So
Yeah. And I
great.
think one thing that I thought of when you were saying that is asking them about how they feel about secondary markets and private deals on your shares, right? Because I think
Yes.
I've heard about, well, first I've heard about companies where they are completely against any sort of private transaction with your equity. And I understand that they're trying to protect their cap table. But if you know that even if I were given the opportunity, I had a private buyer or a private secondary market company, which there are a lot now, or someone was offering me a forward contract where I could get cash now and deliver shares at liquidity, and then my company completely denied me, would I be okay with that? Right? It could be $1 million and someone's ready to pay me at a Series D or something like that, and the cap table says no. I think that's something we should know up front, right? Because that's literally taking money out of your employee's pocket. It's sort of just important to know. So
That's really that's a very interesting way of being able to question that, but in a way which is almost a bit structured, a
yep,
way which is like a hypothetical scenario, but one whereby it elicits a response, and then you get a sense of, okay, what would they do? I mean, my learnings, I guess, from my experiences or from my mistakes has always been like, as much as you possibly can, try to get a sense of the person that you're negotiating with. And if you don't feel
yep,
like you can get a sense of that person, then go to the next person and try and get a sense of them, so that you are getting what you feel like is a truthful response, and look them in the eyes, and
yep.
all of those
Well
great things.
said. Well said.
Um, and so I think I've just got one kind of point around vesting that
Sure.
we've covered a little bit, but I just want to dive into it again. So you mentioned, Mark, that a lot of equity offers right now are, they're typically around 4 years. But can you just delve into that a little bit more again? What would be potentially and I again want to angle this from kind of, okay, where should a person be worried? So if someone was given a vesting schedule that was a bit unusual, what would that potentially look like?
Yeah, I think the industry has really gone towards a standard 4-year vesting schedule with a 1-year cliff, which, just again, to be very clear, is 1 year at your 1-year anniversary with the company. Unless you were able to early exercise and pay for the shares, you will vest 25% of your original grant, right? So if I was granted 10,000 shares, my first year anniversary, I'll get 2,500 options, and that will be able to be exercised if I choose. The rest of that is typically a monthly vest. So you take the rest of that 75% divided by 3 years times 12, which is 36 months, and there will be a monthly vest thereafter. If it was any longer than that, or if there was sort of a stipulation around when it would vest, or just some sort of odd schedule where it says, oh, you're going to have a 1-year cliff, but then monthly thereafter, you'll vest 0.06% for the next 6 years or something, that would just be a very sort of unusual sort of vesting schedule. If the vesting is tied to any sort of company metrics, or it's very rare, but if they said, oh, you can vest in these shares, but only if we hit these revenue targets, again, this is very rare, but those would be things that would be a red flag. The other thing that we haven't touched on yet is when you leave the company, what happens to your equity, right?
Yep.
That is a critical component. And some companies will say, yep, if you're vested and you've exercised, we'll give you this window. Typically it's 90 days. For ISOs, they will convert to NSOs, which is important. Or I'm sorry, it's NSOs to ISOs. Nope, it's ISOs to NSOs. Yeah. So ISOs to NSOs, just to be very clear, after 90 days. But some companies will say, we'll give you a 10-year window to exercise, right? That's very generous. But again, that could be the difference if you're evaluating two different offers. If one company says, yep, as soon as you leave, your equity is either gone or it's 90-day window. But the other company could say, we'll give you a 10-year window to exercise because we want you on our cap table. We want you to share in our success if you've been here for 4 years, for example. So that's really a critical component.
Okay, I actually had not come across that recommendation before. I think that's brilliant. I think that's really interesting. Brilliant. And I have one final question, Mark, which is, and I'm basing this on, again, a lot of this is from either ex-colleagues, friends, and my own experience. But when you get an equity offer through, one of the things many people start to do is they, first of all, look at the equity offer, and it can feel quite overwhelming and confusing, and it's riddled in kind of terminology that they're not necessarily familiar with. In the past, I've used people as a sounding board, but actually I would argue that that hasn't always benefited me. And I would argue that other people who I know that's using other people as a sounding board hasn't helped them either, because people are biased because of their own experiences. And my question, I guess, is, what is a practical and, as much as possible, unbiased way of kind of helping people understand the offer that they've been given? Like, basically, if they're seeking counsel, how should they do that, and who should they go to, and what kind of tools should they look for?
Absolutely. So I'll give you the biased answer and the unbiased answer. The biased answer is a financial advisor, financial planner, wealth manager who works with tech employees or startup employees all day, every day, because they've seen dozens of offers. They know kind of what the things to look for are, and they might know your personal circumstances if you work with them. If you don't work with an advisor, there are so many resources out there, which I'm very happy to say have gotten better and better. There are offer calculators. Compound actually has an offer calculator.
I love
You go to
yeah.
if you go to withcompound.com, you can put in your cash and the series or the stage that the company is in, the cash component, the dilution expectations, and it will kind of annualize what that compensation might look like, even out to a negative component. If it says your equity component might be negative, right, over the years, it's just not worth it. The other way is forums like Quora or Reddit. There's so many things, or Bookface if you're part of Y Combinator. There's so many forums where you can post anonymously and say, here's my offer. Somebody might have seen a similar offer at that company or at a similar company and say, you're being undervalued, right? For CTO at this stage with your experience, you are completely being undervalued. And it's always based on percent, not based on shares, because shares could mean anything.
Yes.
So I think those are the two main options. There's so many resources out there. I would not ask necessarily your colleague in a Slack channel or something like that. They just don't know your own personal circumstances.
Yes.
They can be helpful resource in their own experience. I wouldn't ask your friend or your brother, or your mom or sister. They just don't know you and they don't know the company. But I would ask either an online forum that's very educated, or a financial planner, or someone in that HR department at that company. Because I think sometimes they can be very honest and open about kind of what that equity component looks like.
Yeah, absolutely. And I am just going to emphasize again, I've had good experiences for certain, but in those experiences where I've made just mistakes because of my kind of lack of knowledge or awareness, I just really wish I had done either of those things. Like genuinely, I wish I had just either spoken to a financial advisor or went on to an online forum and asked that question to a fairly unbiased audience because they don't know you. I really wish I had done that. So I think that's just really great, sound, solid advice. So thank you.
I just got an email this morning from a client who got a new offer, and he sort of wants me to help him compare this offer, but also what would happen if he left his existing company, which is very on a track to be very highly valued. And so those are exactly the things we do. And I think the other part of it is just knowing where to kind of look for those kind of nuances. And it's just hard sometimes. So
it really is hard. Yeah. And again, when you're wrapped up in the excitement of a job offer, then you can easily just push them to your back of your mind, and then you start the job, and then a couple of months later you might be regretting something. Exactly. Thank you so much, Mark. That was incredibly helpful, and I hope people find it really useful. I'm sure they will.